Hi guys! Enjoy John's analysis.
32 coins. That is the number that broke the narrative. On June 1st, 2026, Strategy, the company that Michael Saylor spent 4 years turning into the single most visible Bitcoin conviction vehicle on Earth, disclosed that it had sold 32 Bitcoin between May 26th and May 31st, $2.5 million, against a portfolio of 843,706 Bitcoin worth more than $63 billion. The reaction was immediate. Bitcoin fell from $73,700 towards $70,000 within hours of the disclosure. Over the following week, it would fall to $59,100, down 19.3% in 7 days. $160 billion in total crypto market value was erased. $1.75 billion in leveraged positions were liquidated in a single 24-hour window. 351,233 traders were wiped out. The fear and greed index fell to 8 out of 100. The longest ETF outflow streak in the history of U.S. spot Bitcoin products extended to 13 consecutive days, draining $4.4 billion from the market. And the story that every outlet ran was the same story. Saylor broke his never sell promise. The man who said he would never sell sold. The pillar of institutional conviction had cracked. Panic was justified. Here is the problem with that story. Every single material fact it rested on was either wrong, incomplete, or missing the most important number in the entire sequence. Not one outlet led with the fact that Saylor had announced the sale 27 days earlier on a live earnings call in front of analysts and shareholders using the word inoculate. Not one headline mentioned that in the same week the 32 coins were sold, Strategy was simultaneously purchasing 1,550 Bitcoin, 48 times more, at $12,000 below the price it had just sold at. Not one piece of coverage explained that the 32 coins represented 0.0038% of the company's holdings, that the sale was executed above Strategy's average cost basis and above Bitcoin's market price at the time of execution, or that the company finished the week with a $1 billion USD reserve and a larger Bitcoin treasury than it started with. The market read a headline. You may have acted on that headline. This video is about the 5 things that headline got completely wrong, and what the full picture actually says about the holder who stayed versus the holder who sold into the noise. Stay until the end. Because the last thing I'm going to give you is not just the 5th thing the market got wrong. It is the framework that makes this, the last time a week like this one, costs you anything. Before we get into the 5 things, 1 second. Drop a comment right now with one honest answer. When you saw the headline on June 1st, Saylor sold Bitcoin for the first time since 2022, what did you do? Nothing. Check the price or open the exchange. One word. Because at the end of this video, I'm going to tell you exactly what your answer reveals about the one thing separating the holders who made it through this week from the holders who did not. I want to be specific about who this video is for. You hold Bitcoin. You have held it through the kind of drawdowns that would have broken most people. You held through the FTX collapse at $15,476 when every financial publication was writing the asset's obituary. You held through the recovery. You watched Bitcoin go from $15,000 to $126,198 on October 6th, 2025. And for the first time in the cycle, it felt like the thesis was being confirmed in public, in front of every institution and every regulator and every commentator who had spent years calling it worthless. And then the drawdown came. From 126,000 back through 90,000, through 80,000, through the dark pool headlines and the shift predictions and the ETF outflow streaks. You held through all of it. And then on June 1st, the headline hit. The man who had built the world's most visible corporate Bitcoin treasury, 843,000 coins, more than 4% of total supply, disclosed that he had sold some. Not a lot, 32. But the number did not matter to the market. The symbol mattered. And the symbol hit you somewhere specific. The quiet doubt that had been building through months of drawdown suddenly had a hook to hang itself on. If Saylor is selling, what do you know that he does not? That feeling is the subject of this video, not because it is irrational. It is a completely understandable human response to a genuinely ambiguous signal landing in a fragile market. But the feeling was built on 5 pieces of incomplete information, and once you have the complete picture, the ambiguity disappears entirely. Here are the 5 things the market got completely wrong. Wrong thing number 1. You thought it was a surprise. It was not a surprise. Saylor told you it was coming 27 days before it happened, in public, on a recorded earnings call, using language so specific that it left no ambiguity about intent, timing, or purpose. On May 5th, 2026, Strategy's Q1 earnings call, Michael Saylor said in front of analysts, shareholders, and every financial journalist covering the company, "We will probably sell some Bitcoin to pay a dividend just to inoculate the market, just to send the message that we did it." Strategy CEO Feng Lei was even more explicit. "We will sell Bitcoin when it is advantageous to the company." Inoculate. That is a medical term. You inoculate a system by introducing a small controlled dose of something to prevent a larger, uncontrolled reaction later. Saylor was not talking about exiting Bitcoin. He was describing a planned, deliberate, sub-1% operational action designed to demonstrate to rating agencies, preferred stockholders, and short sellers who had argued for years that Strategy was structurally trapped in its position, that it was not. The sale was the proof of concept, not the beginning of an exit. Source, CoinDesk, May 5th, 2026. Source, Decrypt, June 1st, 2026. And the prediction markets knew. Before the earnings call, Polymarket had the probability of Strategy selling any Bitcoin in 2026 at 12%. After Saylor's inoculate comment, the probability jumped to 90% within a single trading session. The information was public, priced, and on record. When the actual sale was disclosed on June 1st, 27 days after the warning, the market reacted with the force of a surprise, despite having had 27 days to process the information. Source, CoinDesk, June 1st, 2026. Strategy's Bitcoin sale sparks a $14 million crypto betting chaos on a major prediction market. That is not an information failure. That is a behavioral failure. The market read the news cycle, not the earnings call, and the holders who reacted to the June 1st headline were reacting to information that had been available on May 5th, priced into prediction markets at 90%, and described in Saylor's own words as a deliberate, pre-planned, small-scale operational action designed explicitly to prevent the exact panic that it produced. The inoculation failed, not because the sale was unexpected. It was entirely expected, because the market was not listening when the warning was given. You did not miss a surprise. You missed a press release that was issued 27 days after the announcement it was confirming. Wrong thing. Number 2, you thought it was a meaningful financial event. It was not. The arithmetic is so stark that stating it out loud should have ended the coverage immediately. Strategy sold 32 Bitcoin at an average price of $77,135 per coin. Total proceeds, approximately $2.5 million. The company retained 843,706 Bitcoin worth more than $63 billion at aggregate cost. The 32 coins represented 0.0038% of total holdings. Let us translate that into a number that has some intuitive meaning. If you owned 10,000 Bitcoin, a position worth approximately $650 million at current prices, 0.0038% of your position would be less than half a single coin, less than half a coin. That is the scale of what happened on June 1st, 2026, as a proportion of Strategy's total position. VAS Block published the ratio that tells the complete story. Strategy received $2.5 million from the sale. The crypto market lost $160 billion in total value over the following week. That is $64,000 of aggregate crypto market value destroyed for every single dollar Strategy received. Source, VAS Block, June 3rd, 2026. Strategy sold 32 Bitcoin. The market lost $160 billion. The ratio is the entire story. And the sale was executed above cost basis. Strategy's average purchase price across its entire position is $75,699 per coin, confirmed in the June 1st SEC Form 8K filing. The 32 coins were sold at $77,135, above the average, above the market price on the day of disclosure, at a profit. This was not a distress sale executed below cost basis to meet an emergency obligation. It was a routine treasury management action that generated a small realized gain on a small number of coins to meet a specific quarterly dividend obligation. The kind of transaction that happens in institutional treasury management every day without generating a single market-moving headline. JP Morgan analysts describe the sale as symbolic and voluntary. Source, The Block, June 3rd, 2026. Rajiv Sawhney, head of international portfolio management at Wave Digital Assets, said directly, "Strategy selling 32 BTC for $2.5 million is financially trivial, a rounding error against its $62 billion position. What it signals to the market, given Bitcoin's underperformance in recent weeks, matters more." Source, Yahoo Finance, June 3rd, 2026. Bitcoin's break with tech widens. After Strategy's sale feeds. Route. The financial event was immaterial. What moved the market was the symbol. the puncturing of the never sell mythology. But the mythology was already being retired by Saylor himself on May 5th, using the word inoculate. The market simply was not listening when the retirement was announced. Before we get to wrong thing number 3, 30 seconds. The Bitcoin Holder's Bible was built for exactly the week you just lived through, not as a theoretical framework for calm markets, as a practical decision architecture for the specific moment when a headline lands in a fragile environment and every cognitive force in your brain is pointing toward action. The 5 wrong things the market believed this week are not random errors. They are the predictable outputs of a holder navigating market events without a pre-committed protocol. The holder with a protocol ran the 4-signal check when the June 1st headline hit and got 1 answer. 0 of 4 distribution triggers activated. No action required. The holder without a protocol navigated the week with a Watcher Guru notification as the tiebreaker. The retail price for the Bible is $97. Because you are staying through this correction to look at the complete picture rather than the headline version, if you stay until the very end of this video, I'm going to give you a $50 voucher. Your price, $47. That code is coming at the end. Stay with me. Wrong thing. Number 3, you thought the sale caused the crash. It did not. The sale was the trigger for a specific sentiment reaction in a market that was already loaded with 4 separate structural pressures converging simultaneously. The crash had structural causes that existed before a single coin was sold. Cause 1, the Federal Reserve. On June 5, 2026, the U.S. Bureau of Labor Statistics reported 172,000 new non-farm payrolls in May, nearly double the 85,000 economists had forecast. That single data point destroyed any remaining probability of Federal Reserve rate cuts before 2027. The algorithmic response across every risk market was immediate and predictable. Higher risk-free yields compete directly with non-yielding assets. Bitcoin, despite its positioning as a macro hedge, responded to a hawkish surprise exactly as a leveraged risk asset responds. Source, Crypto.News and Bigot News, June 8, 2026. Because 2, geopolitics. Overnight on June 4th, Hezbollah rejected Israel's ceasefire offer, adding another risk-off layer to a market already stressed by weeks of Strait of Hormuz tension that had been keeping oil above $93 per barrel. These were external macro shocks, creating repeated risk-off episodes throughout May and June. They had nothing to do with Saylor, with strategy, or with Bitcoin's structural thesis. Cause 3, leverage. The derivatives market had been building dangerous leverage through May. The $1.75 billion in liquidations that cleared on June 5th was not caused by the strategy sale. It was caused by the automated position closing mechanics of a market carrying excessive long exposure at prices between $70,000 and $80,000. When price broke key support levels, stop losses cascaded. The selling fed itself. This is the documented pattern in every significant Bitcoin correction. The strategy sale provided the psychological trigger. The leverage structure produced the scale. Source, CoinGlass via newsbitcoin.com, June 5th, 2026. Cause 4, the ETF outflow context. The 13 consecutive day outflow streak preceding the June 5th low was not triggered by the strategy sale. It was already underway before the sale was disclosed. BlackRock's IBIT had recorded its largest single-day outflow of 2026, $1.3 billion, before the June 1st filing. The ETF outflow pattern reflected broader institutional rotation. AI equities hitting all-time highs, while macro conditions tightened and Federal Reserve rate cut expectations deteriorated. The strategy sale accelerated a trend that was already moving. It did not create it. The complete picture, 4 structural forces converged on a derivatives market loaded with leverage. The strategy sale was the psychological trigger that made the fear cohere into a single narrative. Blaming 32 coins for $160 billion in market cap destruction is the equivalent of blaming the spark for a fire that was built, loaded, and ready before the match was struck. Source, Block Ops Mining, June 4th, 2026. Wrong thing number 4. You thought strategy was selling. It was buying. This is the number that should have ended the narrative, and it received approximately 1% of the coverage that the 32 coin sale generated. In the same 7-day window that produced the 32 coin sale, strategy was running its at-the-market equity program, selling shares of MSTR common stock into the open market, converting proceeds into Bitcoin. Between June 1st and June 7th, the company raised $181 million through the sale of 1,409,600 MSTR shares. It deployed $101.3 million of those proceeds into Bitcoin. On June 8, 2026, Strategy disclosed in an SEC Form 8K 1,550 Bitcoin purchased between June 1st and June 7th at an average price of $65,100 $332 per coin. Total, $101.3 million. Source, SEC Form 8K, June 8th, 2026. Source, Bitcoin Magazine, June 8th, 2026. Source, The Defiant, June 8th, 2026. The arithmetic that every outlet covering this story failed to lead with. Strategy sold 32 Bitcoin at $77,135. Strategy bought 1,550 Bitcoin at $65,332. The ratio, 48 times more purchased than sold. The price differential, $11,803 cheaper per coin on the buy than the sell. The company sold at a higher price and bought back at a lower price in the same 7-day window, executing a textbook cost basis reduction at scale while the market was processing the narrative of institutional abandonment. And the company finished the week structurally stronger than it started. The USD reserve, established in December 2025 specifically to fund preferred stock dividends and debt interest, reached $1 billion for the first time. Source, The Defiant, June 8th, 2026. This matters because the operational trigger for the 32 coin sale was a dividend obligation. With a $1 billion cash buffer now in place, Strategy has structurally addressed the mechanism that produced the sale. The 32 coin event is not the beginning of a selling program. It is the demonstration that prompted building the reserve that makes future small sales unnecessary. The market spent 2 weeks processing the grief of 32 coins leaving the treasury. In the same 14 days, Strategy was executing the largest single-week Bitcoin purchase since April, finishing with a total of 845,256 Bitcoin, 48 times more coins purchased than sold, at $12,000 cheaper per coin. The coverage ratio between those two events is the most accurate available measure of the gap between what the market was reading and what was actually happening. Here's the context that every outlet covering the 32 coin sale failed to include. Not because it was hidden, because it required reading more than the headline. In the first quarter of 2026 alone, Strategy deployed more than $7 billion into Bitcoin accumulation across multiple capital raises. In April, the company purchased 34,164 Bitcoin for approximately $2.54 billion at an average price of $74,395 per coin. Source, CoinDesk, April 20th, 2026. In May, before the 32 coin sale, Strategy purchased 24,869 Bitcoin at an average price of approximately $80,985 per coin via its STRC preferred stock capital raise, bringing total holdings to 843,738 Bitcoin. Source, CoinDesk, May 18th, 2026. The total, well over 100,000 Bitcoin accumulated in the first 5 months of 2026, against 32 coins sold. Strategy also noted in its June 1st filing that the company had purchased 2.6 times the amount of Bitcoin mined in 2026 so far, describing itself as a bitvac, a reference to its systematic absorption of available supply. Source, The Block, June 1st, 2026. The company that describes itself as a Bitcoin vacuum cleaner sold 32 coins to pay a dividend. The vacuum kept running. The market reacted to the 32 coins and ignored the vacuum. The December 2022 precedent is directly relevant. Strategy previously sold Bitcoin once before at scale, in December 2022 at the depth of the FTX bear market. The company sold 704 Bitcoin at $16,776 per coin for approximately $11.8 million in proceeds, then repurchased 810 Bitcoin 2 days later. The purpose was tax loss harvesting. In 2026, the playbook evolved. Sell a small amount above cost basis to meet a dividend obligation. Immediately purchase a much larger amount at a lower price using equity proceeds. Both transactions follow identical structural logic. Small operational sale, larger immediate buyback. The market treated the 2022 version as routine, the 2026 version as a crisis. The only thing that changed was the sentiment environment. Source, Decrypt, June 1st, 2026. The most elegant data point in this entire story received approximately zero coverage. On June 8th, 2026, the same Monday that Strategy disclosed its 1,550 Bitcoin purchase, Strive Asset Management, the Dallas-based Bitcoin treasury company led by Chairman Matt Cole, disclosed that it had purchased exactly 32 Bitcoin between June 2nd and June 7th at an average cost of $63,911 per coin, for a total outlay of approximately $2.1 million. The purchase brought Strive's total holdings to 19,032 Bitcoin, valued at approximately $1.15 billion. Source: Bitcoin Magazine, June 8, 2026. 32 Bitcoin, the exact number Strategy had sold. Matt Cole described the purchase explicitly as a direct response to the amount Strategy had sold the prior week. One institution sold 32 coins to fund a dividend obligation. Another institution bought the same number as a public statement of conviction at the prices the panic had produced. While the market spent 2 weeks processing the symbolic meaning of 32 coins leaving Strategy's treasury, a competing institution was simultaneously buying the same number as a deliberate, on-record act of institutional conviction. That asymmetry, where a small sale dominates the narrative while an equivalent purchase is treated as a footnote, is the fear mechanism operating at full power, selecting which information reaches the holder's attention based on emotional salience rather than analytical relevance. The entity on the other side of your fear had a name, a balance sheet, and a press release. You just were not reading the right press release. Wrong thing number 5. You thought the institutional conviction had broken. It had not. And the data published on June 8, 2026 confirmed it comprehensively. Bernstein published a research note on June 8th using Glassnode data. The finding: 61% of Bitcoin's circulating supply has remained inactive for more than 1 year. Source: The Block via Bernstein, Gautam Chugani, June 8th, 2026. 61%. More than 6 out of every 10 Bitcoin currently in circulation has not moved in over 12 months. These are not coins held by retail investors refreshing their portfolio apps every hour. These are coins held by entities with conviction deep enough to absorb months of drawdown, a 51% decline from the all-time high, 13 consecutive days of ETF outflows, a fear and greed index of 8, a Schiff $20,000 prediction, and a Sailor sale headline, and still not move. The 32 coin sale did not change that number. The 48 times buyback did not change that number. The holders, sitting on 61% of circulating supply, were not moved by any of it. Bernstein's conclusion, stated explicitly in the June 8th note: the long-term store of value thesis for Bitcoin remains unchanged. Net inflows into Bitcoin ETFs and corporate treasury companies in 2026 stand at $12 billion. That number is lower than 2025's $60 billion because retail investors are crowding into AI equities. But the institutional base, pension funds, endowments, wealth management platforms, sovereign wealth funds, is not leaving. It is consolidating its position. 198 public companies now operate some form of Bitcoin acquisition model, according to Bitcoin Treasury's data reported by The Block on June 8, 2026. That number was a 0 in 2019. The corporate treasury infrastructure that Saylor built is not dismantling in response to 32 coins. It is expanding. The institutional conviction did not break on June 1st. The retail narrative about institutional conviction broke. Those are not the same thing. Here is what a holder with a written protocol did on June 1st, 2026, when the Strategy sale headline hit. They ran the 4-signal check. Signal 1, NUPL above 0.65? No. Current reading, approximately 0.24. At the boundary of capitulation territory. Distribution threshold is 0.65, not triggered. Signal 2, LTH distribution rate above $500 million per day? No. LTH SOPR at approximately 0.819 indicates long-term holders are selling at a loss. Capitulation behavior, not profitable distribution, not triggered. Signal 3, MVRV Z-score approaching 6 or 7? No. Current reading, approximately 0.41, 1/10 of the levels that have historically coincided with cycle tops. Not triggered. Signal 4, SECI sell signal generated? No. The stablecoin cycle composite index fired on September 22, 2025, 14 days before the all-time high of $126,198. It has not regenerated, not triggered. Protocol output: 0 of 4 distribution triggers activated, no action required. The Strategy sale was a market event. Market events do not override protocol signals. The protocol output on June 1st was identical to the protocol output on every other day in 2026. Hold. The holder who ran this check on June 1st did nothing. They watched the price fall to $59,100, watched the fear and greed index reach 8, watched 351,000 traders get liquidated, and watched Strategy buy 1,550 Bitcoin on June 8th. They held a position that recovered from the wick with the protocol unbroken and the long-term structural signals unchanged. The 5 wrong things are not random errors. They are the predictable outputs of 3 specific cognitive mechanisms operating under pressure. Loss aversion. Daniel Kahneman's prospect theory, published in Econometrica in 1979 and foundational to his Nobel Prize in 2002, established that human beings experience losses approximately twice as powerfully as equivalent gains. At Bitcoin's all-time high of $126,000, your brain established a reference point. Every dollar below that reference is processed with the emotional intensity of a direct financial loss, regardless of actual entry price. This is why a holder who bought at $30,000 and is sitting on more than double their investment can still feel like they are losing when the price is at $63,000. They are not losing. Their brain is reporting the gap between the reference point and current price as a loss because that is what the mechanism does. Recency bias. During every Bitcoin bear market without exception, the dominant narrative at or near the bottom is that the decline will continue indefinitely. Investors extrapolate recent price performance into the future, creating maximum pessimism at precisely the moment the on-chain data is most consistent with a bottom formation. The fear and greed index at 8 is not a signal that the market is structurally broken. It is the signal that has historically preceded the largest subsequent price gains. The Kraken FOMO and FUD survey, conducted in October 2024 across 1,248 participants, found that 81% of crypto holders have made decisions based on fear, uncertainty, and doubt, and 63% said those decisions negatively impacted their portfolio. Narrative capture. When a complex, multi-causal event is given a single clean cause by every major outlet, that narrative becomes the lens for all subsequent information. The 32 coin story was a clean narrative. One man, one company, one betrayal. The four-cause structural reality was not clean. It required reading a jobs report, understanding ETF mechanics, tracking leverage data, and following geopolitical developments simultaneously. The clean narrative won, the analysis lost, and the holder without a pre-committed protocol made their decision inside the clean narrative, not the structural reality. Go back to the comment you dropped at the beginning of this video. Nothing. Check the price or open the exchange. Nothing. And you either had a protocol that confirmed 0 of 4 triggers or conviction deep enough to hold without one. If it is the first, you navigated this week correctly. If it is the second, understand that conviction without a system is comfortable certainty until the pressure reaches the level that certainty cannot hold. This week showed what that level looks like. Check the price, and you were watching the right data point for the wrong reason. Price is the output. The protocol signals, NUPL, MVRV Z-score, LTH SOPR, RHODL, are the inputs. Checking price during a panic is equivalent to checking your engine temperature by looking at how fast you are moving. The number that tells you whether to pull over is on a different dashboard. Open to the exchange. And you now have the complete picture of what you were responding to. A headline built on 5 incomplete facts, amplified by 3 cognitive mechanisms. Your brain runs automatically under pressure, in a market environment created by 4 macro forces that had nothing to do with Saylor's conviction. The decision you almost made was not caused by weak conviction. It was caused by the absence of a framework that converts the 5 correct facts into one pre-committed answer before the headline arrives. Here is what the verified data says as of June 8th, 2026. Strategy sold 32 Bitcoin for $2.5 million. Strategy bought 1,550 Bitcoin for $101.3 million in the same 7-day window, 48 times more, at $12,000 cheaper per coin. Total holdings now stand at 845,256 Bitcoin. The company's USD reserve reached $1 billion, structurally removing the operational trigger for future small sales. 61% of Bitcoin's circulating supply has not moved in over 1 year. Bernstein confirmed the store of value thesis is intact. 198 public companies hold Bitcoin as a treasury asset. The MVRV Z-score sits at 0.41, 1/10 of historical cycle top levels. 0 of 4 protocol distribution triggers have been activated. The verdict. The holder who sold into the 32 coin narrative sold into a story built on 5 wrong things, at prices that the entities with the most accurate information were buying. You stayed until the end. Here is what that tells me. You are the holder who wants the complete picture, not the comfortable one. That instinct is rarer than it sounds, and it is the only thing that actually matters in a week like this one. The regular retail price for the Bitcoin Holder's Bible is $97, but because you invested the time to get through the 5 wrong things, the protocol check, the accumulation context, the strive response, the behavioral finance, and the honest mirror, use the voucher code I promised you, DIAMOND50, all caps, DIAMOND 50. That code applies your $50 voucher directly at checkout. Your total, $47. Let me put $47 in context with the week you just survived. Strategy sold 32 Bitcoin for $2.5 million, and the market lost $160 billion. $64,000 destroyed for every dollar received. If even 1% of that destruction touched your portfolio and you managed a position of any meaningful size, the gap between having a protocol and not having won cost real money. Not theoretical money. Real money measured in Bitcoin sold below the price that 48 times more was bought at 1 week later. The complete on-chain signal framework, NUPL, MVRV Z-score, RH-Odell ratio, LTH SOPR, with the specific thresholds that define each activation state, exactly as I walked through in the protocol check. 0 of 4 triggers. Hold. The distribution ladder with 3 pre-committed signal-based exit rungs. Rung 3 requires the convergence of 3 simultaneous signals, the same framework that fired on September 22, 2025, 14 days before the all-time high of $126,000, allowing holders who had built their protocol in neutral conditions to distribute near the top. The Never Sell Core worksheet. The percentage of your position you define in writing in advance as the amount you hold regardless of price, narrative, or market events. A 32 coin strategy sale headline is a market event. The Never Sell Core is not a protocol trigger. The weekly protocol check. 5 minutes, once per week, 7 questions, 1 output, action or no action. The exact check I ran in this video, 0 of 4. Hold. 6 composite holder profiles, including Sarah, who built the system in neutral conditions and distributed near $109,000 in September 2025 because she had pre-committed exit criteria 14 days before the all-time high. And Marcus, who held with genuine conviction through everything and sold at $64,000 in March 2026 without a signal because the accumulated pressure became unbearable without a framework. The security framework. Because between 1.5 and 2 million Bitcoin are permanently lost due to inaccessible private keys, data from Chainalysis and River Financial 2025. And the holder who builds the protocol but not the custody plan has left the most fundamental gap unaddressed. The inheritance documentation framework. Because the holder who gets there and cannot pass it on has not finished the work. $47. Code Diamond50. Link below and pinned in comments. Do not be the holder who knows the 5 wrong things after the fact. Be the holder who had the answer before the headline arrived. Before you close this video, 1 action. Open Glassnode's free tier right now. Find the NUPL chart. Write down today's reading. Open Macro, find the MVRV Z-score. Write down today's reading. Date both entries. June 8th, 2026. Then hold those 2 numbers next to the answer you dropped in the comments. Nothing. Check the price or open the exchange. The gap between the numbers you wrote and the action you took, that is the exact size of the system you need to build. If you want the complete framework, the Bitcoin Holder's Bible is $47 today with code Diamond50. Link below. Subscribe so you do not miss the next video, which covers the 3 specific conditions that would actually justify selling and exactly what the on-chain structure will look like when those conditions are genuinely met. A system that only tells you to hold is not complete. A complete system tells you both when to hold and when to act. And if this video gave you something concrete today, share it with one holder who is still navigating the 32 coin story without the complete picture. Because today is exactly the kind of day when the gap between a framework and a feeling costs holders the most. All data in this video was verified on June 8th, 2026, the day of production. Sources are listed in the pinned comment below. See you next time.